Do you want to know the 7 best index funds that can make you rich? But first, what are index funds? Well, in simple terms, index funds are a type of investment fund within the broader category of mutual funds. They operate under a simple premise: to mirror the performance of a specific index. For example, an S&P 500 index fund aims to parallel the performance of the S&P 500 by owning the same stocks in the same proportions. This differs from actively managed funds where fund managers handpick stocks and bonds in an effort to outperform the market. Index funds, on the other hand, are passively managed, which results in lower management fees. The beauty of index funds is that they offer broad market exposure. You're not just investing in one company or sector, you're investing in a wide array of companies. This helps to spread the risk and can lead to more stable returns over time. So, if you're looking for a cost-effective way to diversify your portfolio, index funds might be your answer. You might be wondering, why should you invest in index funds? Well, let's delve into the perks. Firstly, index funds offer diversification. Investing in a single index fund is like buying a small piece of all the companies in that index. This spreads out the risk, so if one company falters, others can help balance out the loss. Next, let's talk about growth. Index funds are designed to mimic the performance of a specific market index. Over the long haul, market indices have shown a consistent upward trend. So by investing in index funds, you're essentially betting on the overall market's growth potential rather than trying to pick individual winners. Finally, index funds are a great fit for all levels of investors. If you're a beginner, they offer a straightforward way to enter the market. For the experienced investors, they provide a stable, low-cost backbone for a diversified portfolio. Whether you're a newbie or a seasoned investor, index funds offer a simplified yet effective investment strategy. So, how do you choose the right index fund? Let's delve into this. Firstly, consider the expense ratio. This is the cost of managing the fund, presented as a percentage of your investment. The lower the expense ratio, the more of your money goes towards your investment, not management fees. Next, look at the historical performance. While past performance doesn't guarantee future results, it can provide an insight into the fund's stability and growth over time. Thirdly, consider the tracking error. This is the difference between the fund's performance and the index it's supposed to replicate. A lower tracking error indicates that the fund closely mirrors the index. Beyond these criteria, you need to look at the index that the fund tracks. Some indices follow specific sectors or regions, while others offer broad market exposure. Remember, the right index fund for you depends on your individual financial goals and risk tolerance. Choose wisely. Diversification is key in investing, but how does it work with index funds? Let's break it down. Diversification at its core is about spreading risks across various sectors and regions. Think of it as not putting all your eggs in one basket. Instead, you're spreading your investments across different types of baskets, each representing a unique sector or region. This strategy can help protect your portfolio from the volatility of a single sector or market. Index funds are a great tool for achieving this diversification. They are designed to mimic the performance of a broad market index, and as such, they inherently provide exposure to a wide range of sectors and regions. For instance, an index fund tracking the S&P 500 gives you a slice of 500 of the largest U.S. companies across various industries. By choosing a variety of index funds, you can create a well-rounded, diversified portfolio that can withstand market turbulence. A well-diversified portfolio is your best defense against market volatility. Investing is all about balancing risk and reward. But what does this mean for index funds? Well, like any investment, index funds come with risks. These primarily revolve around market volatility and the potential for losses if the overall market takes a downturn. There's no magic shield protecting these funds from the ebb and flow of the economy. However, there's a silver lining. Index funds, by their nature, spread investments across a wide array of stocks or bonds. This broad diversification helps to mitigate the impact of any single company or sector performing poorly. The result? A smoother, more stable growth trajectory over the long term, compared to individual stocks. Another reward comes in the form of lower costs. Index funds typically have lower expense ratios than actively managed funds, meaning more of your money stays invested and has the chance to grow. While all investments carry risk, index funds offer a potentially lower risk pathway to wealth accumulation. Your investment goals and time horizon play a crucial role in your choice of index funds. Let's break it down. When we talk about investment goals, we're referring to what you're hoping to achieve with your investments. This could be anything from funding your retirement, saving for a down payment on a house, or building wealth over time. Your time horizon, on the other hand, is the length of time you expect to hold your investments before cashing them in. So, how does this influence your choice of index funds? Well, if your goal is long-term wealth accumulation and you have a lengthy time horizon, you might lean towards funds that emphasize growth. On the flip side, if you're nearing retirement and your time horizon is shorter, you may opt for funds that focus on income generation or capital preservation. Remember, there's no one-size-fits-all approach to investing in index funds. Aligning your fund choices with your financial objectives is crucial for successful investing. Investing in index funds isn't a set-it-and-forget-it strategy. It's essential to keep a keen eye on your portfolio and make adjustments as necessary. This process, known as rebalancing, helps ensure that your portfolio continues to reflect your investment goals and risk tolerance. Picture this. You've carefully chosen a mix of index funds, each representing a different sector or region of the market. As the market shifts, some of your investments may outperform others, causing your portfolio to drift from its original allocation. This drift might expose you to more risk than you initially intended, or skew your portfolio away from sectors or regions poised for growth. That's where rebalancing comes into play. By selling off overperforming assets and investing more in underperforming ones, you can bring your portfolio back into alignment. This doesn't mean chasing after the latest hot sector or panicking when the market dips. It's about sticking to your plan, adjusting as needed, and staying the course. Regular monitoring and rebalancing can help keep your portfolio on track to meet your financial goals. Now let's dive into the 7 best index funds that can potentially make you rich. Firstly, we have the Vanguard Total Stock Market ETF, or VTI. This fund tracks the performance of the entire US stock market, providing broad exposure to all sectors and company sizes. It boasts a low expense ratio and has consistently demonstrated solid performance. Next up is the iShares Russell 2000 ETF, also known as IWM. This fund is perfect for those looking to invest in small-cap US stocks. It's a great way to gain exposure to the dynamic and often high-growth world of smaller companies. Let's move on to the Invesco QQQ Trust, or QQQ. This fund tracks the NASDAQ 100 index, which is heavily weighted towards technology and growth stocks. If you're looking to capitalize on the tech boom, this might be the fund for you. Fourth on our list is the Vanguard Total International Stock ETF, or VXUS. This fund offers global diversification, investing in companies outside the US. It's an excellent choice for those seeking international exposure in their portfolio. Coming in at number 5 is the SPDR S&P 500 ETF Trust, also known as SPY. This fund mirrors the performance of the S&P 500 index, one of the most widely followed equity indices in the world. It's a reliable choice for those seeking steady long-term growth. Next we have the Schwab US Dividend Equity ETF, or SCHD. This fund focuses on high-dividend US stocks, making it a great choice for income-focused investors. Last but not least, we have the iShares MSCI EAFE ETF, or EFA. This fund provides exposure to developed markets outside North America, offering a nice balance of geographical diversification. Each of these funds has its own unique focus, performance history, and expense ratio. They all offer a different slice of the market and can be used to build a diversified, balanced portfolio. Remember, the best index fund for you depends on your individual financial goals and risk tolerance. So, there you have it. The 7 best index funds that can make you rich. We've explored the world of index funds from their definition and benefits to the key criteria for choosing them. We've highlighted their potential for diversification and long-term growth, making them suitable for both novice and seasoned investors. We've also touched on the importance of aligning your choice of index funds with your investment goals and time horizons, as well as the need for regular monitoring and rebalancing. Remember, the availability and performance of index funds can change. Always conduct your own research and consider consulting with financial professionals before making investment decisions. Investing in index funds is not just about making money, it's about securing your financial future and achieving your goals. So, what are you waiting for? Start your journey towards financial freedom today. Research, invest, and watch your wealth grow.